You're watching Mirror 7 News. Stay informed, stay ahead for more news.
Let's talk about one of the most remarkable stories in Canadian tech investing right now. Celestica, ticker symbol CLS. If you've been following the stock market even casually, you've probably heard whispers about this one. But here's the real scoop. Celestica has been absolutely soaring, and some seasoned experts are now saying it might be time to lock in a few gains. Celestica is a Toronto-based company that originally spun out of IBM and went public in 1998. For almost 2 decades, its stock hovered between $5 and $15. Steady, unexciting. That is, until 2023. Since then, the stock has skyrocketed. In 2023 alone, it jumped by 154%. Then in 2024, it surged another 242%. And it's not done. So far in 2025, the stock is up another 66%. This isn't just a good run, it's a full-blown breakout. Now, it's easy to get caught up in the excitement, but let's look at some context. While most Canadian tech stocks have been lukewarm this year, the S&P/TSX Information Technology Index is only up about 8%, and even giants like Shopify and Constellation Software have shown relatively modest gains. Celestica has continued defying gravity, smoothing's ear. One major investor, Gordon Pape, added CLS to his recommended list back in November 2023, when it was trading at just under $39. Today, it's pushing past $219. That's a 471% gain in less than 2 years. Pretty incredible, right? But here's where things get interesting. Despite the meteoric rise, Pep is now advising investors to take a little off the table. Sell half, in his words. The reason isn't necessarily a warning of trouble, but more a signal that the stock is getting expensive. Its price-to-earnings ratio has climbed to nearly 45, which is high, even for a tech company, though still under Nvidia's, which trades around 55. To be fair, the fundamentals at Celestica are still strong. In the first quarter of 2025, they posted $2.65 billion in revenue, up 20% from last year, and earnings came in at $1.20 per share, beating expectations. The company even raised its full-year guidance, now expecting $10.85 billion in revenue and $5 in earnings per share. They don't pay a dividend, but they've been buying back shares, $75 million worth last quarter alone. That's often a good sign. So, what's the takeaway? If you've been riding this rocket, now might be a smart time to take some profits. If you're thinking of jumping in, it may be best to wait for a pullback, perhaps below the $210 mark, before making a move. Either way, Celestica has become a tech stock story worth watching very closely. Stay subscribed for more videos.